Well, welcome everyone. Hope you're having a good holiday season so far. I know it gets a little crazy around this time with office parties, family, shopping, this and that, but appreciate everyone coming on to this webinar. Bonus depreciation is such a powerful tool. It's allowed me to really compound my wealth quite significantly by minimizing my taxes, and I'm able to invest that money. And so we'll go over that today. Do know I'm not a CPA. I don't play one on TV. I'm not giving out tax advice, but what we'll share is our basics. Um, and every CPA is different. I'll talk to some friends that can really use it, and their CPA is super old school. I don't know anyone that's been audited for something like this. It's not a common practice um, to get audited, but I do have some friends that are definitely risk averse to this, and other ones that take advantage of this, and it's huge. It's absolutely huge. So talk to your CPA, go over your unique situation, but we'll try to cover all the bases today. So a little bit about me. I've been a real estate investor since 2002. I've invested in over 3,000 units. Um, I've been running businesses my whole life over the last 30 years. I wrote the Amazon bestselling book Best in Class, which is focused on asset management. So um, definitely recommend that book. It's really the only book out there on asset management. Um, I also worked with at-risk youth throughout Southern California, and we were working with 9,000 students daily. And I founded the nonprofit Core Educational Services. So, what is bonus depreciation? Um, so, through a cost segregation study, bonus depreciation is front loading the write off of items. So instead of typically for real estate for commercial property, I think it's 39 years. For residential, it's 27.5. So we're basically front loading it. Okay. And we hire a company to do a cost segregation analysis for us. And it identifies any of the costs that will be used up in 20 years. So rehab work, new old equipment, that's all will get used up in the 20 years. So we can front load that, which is awesome. So on the bottom, you see the Tax Cuts and Jobs Act of 2017. Businesses can take 100% bonus depreciation on qualified property. So that's huge. So this time of year, you see a lot of people jumping into deals because they want that bonus depreciation. And we do have a deal closing tomorrow, so we do have that opportunity, and we'll talk about that at the end. So I'm just going to use smaller numbers. The property we're closing on is 33 million, but if you take a residential property, it costs $1 million, and typically it's about 15% is valued as a land, and you can go to the assessor's website and find that out. And so you can do straight line depreciation. So on that 850, that 1 million minus 150, if I took it over 27 and a half years, all I can depreciate is $29,000 a year. But with bonus depreciation, I can accelerate that and take it all up front. So this is where it gets a little tricky. So last year, let's say depreciation was 200,000. Last year, I could take 100% of that. But this year, it goes down to 80%. So I can only take 160,000. Next year, it goes down to 60%. But it doesn't mean I can't grab that other 20% next year. So on this year, I get the 160, and next year I can get the 40, which is fantastic. So it's supposed to go down over the next few years. But actually, I read an article today that there's a high probability that they'll reinstate it, that we can take 100% bonus appreciation potentially in as early as 2024. So we'll see how that plays out. But you know that our government officials all invest in real estate, so it would seem like a no-brainer that they reinstitute it. And Adam, feel free to jump in. Adam's on our team, investor relations. So if I if I need some clarifying statements, jump in, Adam. Don't hesitate. All right, so this is a sample cost segregation study. So it's probably a little hard to read, but you can see every little item is deducted and um, run through their process. I'm not a CPA, but switches, breakers, washers, dryers, blinds, shelving, ranges, fan and hoods, gym equipment, microwave, pool equipment. So like all these different things can be um we could use accelerated depreciation, which is fantastic. So on our current deal, we're getting, if you invest 100,000, you'll get a 70% or $70,000 loss on your K1, roughly, give or take once we're all said and done, which is huge. All right, so depreciation is the number one way to legally reduce your personal taxes by sheltering income. Um, for most, personal taxes are your largest expense. But this is when you invest in a syndication, which we do, it's passive losses. Um, so you can use that bonus depreciation against other passive gains. Okay. It can't be used against your income unless you are a real estate professional. And I'll get into that later. But if you have a typical W-2, it's really hard to qualify as a real estate professional if you're not doing your own deals. Um, all right, so like I said, it's $100,000. Let's say you invest, you get 70% bonus depreciation, you get about $70,000 back. Now you take that $70,000, it reduces your tax bill. So let's say you get taxed at 37%, it reduces your taxes by 25,900. We're using these, basic numbers. Your situation may be a little bit different. Um, so let's say um, you had passive gains of $100,000. If you get 70,000 K1 loss, now you only have to pay taxes on the 30,000 at your rate. So that's just another way to look at it. So you can use passive losses to offset your gains and recapture, and I'll get into recapture a little later. But it's a really good kind of lazy 1031. So people come up to us and ask us, "Hey, would you do a 1031?" And we have a minimum of about $750,000 because of all the different things involved. You have to set up a tick. There's a lot more legal fees. It's very complicated. So um, a lot of people have some smaller amounts that they want to 1031, and this is a great way to just offset your taxes. So, if you had like 500,000 and you invest with us, you're through a K1, you're gonna have about a $350,000 loss. You'll give me ahead of the game, with your savings and taxes. So it's a really, really good tool. And this is how the top 1% build wealth. All right, so I really like this graph because it shows how powerful it can be. If you're investing 300,000 every year and you're reinvesting those profits, as a deal sells, you're reinvesting and you're reinvesting your bonus depreciation savings. I mean, look how fast your wealth grows in a short period of time. Now everyone's going to invest, different amounts. Some people may invest less, some people may invest more. We're just using the bonus depreciation savings as they are right now, but it's a really, really powerful tool. So who can use it? So not everyone can use bonus depreciation. If you invest with cash, then yes, you can use it. If you invest with your IRA, then it's already in a tax deferred account, so you can't take advantage of it. You can use passive gains and capital gains. So if you sell stocks or bonds, then you could take advantage of it as well because that's passive income versus passive against passive losses. And like I said, if you're a real estate professional, so um, I qualify. I know I have a bunch of friends that invest in real estate, but it's typically as a passive investor. If you're not doing your own deals, um, it's hard to get qualified. So, one way is to really build up your own portfolio if you want that status, But like I said, talk to your CPA if that's something, maybe your significant other can qualify and really take advantage of this. So one thing that a lot of other people don't talk about is there is recapture. Okay, so if you got a $70,000 loss on your K1, your basis goes down. So you were at 100,000 investment. Now it's 30,000. Okay, and then you're going to get taxed on the gain about on the on the depreciation recapture about 25% maximum. There's different rates for different things, but if you plan on about 25%, I think you're going to be good. But if you're selling a property and you've made, 1.5x, 2x multiple, you're going to get that revenue that you can either pay your taxes on it or reinvest it and not pay those taxes. Use that bonus depreciation again to minimize your taxes. So like I said, powerful tool. One other thing to consider, if you can't take advantage of it, let's say you invest now and you don't have those passive losses to use, you can carry it forward. You can use that bonus appreciation when we sell the property, which is a really nice tool, or when you have passive gains next year or the year after that. So let me stop here and answer any questions that people have because I kind of went through it pretty fast. Let me see. I'm not seeing the, if you see questions, Adam, why don't you ask them because I'm not seeing it here. No questions?
I haven't seen any yet. There's a
All right.
raise hand button. I haven't seen anybody click that yet.
All right. If you have questions, don't hesitate.
Oh,
Oh,
here's
here we go.
yep.
Does 1099 income qualify? I don't believe so because that's 1099 is it could be interest income, it could be independent contractor income. So unless are a real estate professional, then it can, I guess the interest can, I guess. Um, Again, that's a CPA question. But I think if it's a dividend, if that's passive gains, I believe, you should be able to. But I would double check with your CPA. So Spanish Trail, this is a deal we're closing tomorrow. We do have some space available. It's 256 units, Class B in Tucson. This is our ninth deal in Tucson, and we have three properties within 5 miles of this property. As you can see, really nice. It's got a gym, not on this picture, but we have Amazon package lockers. The pictures below, that's the model unit. It's got a mix of 1+1 beds, 2+1, 2+2. Um, Tucson, we've done phenomenally well. It's a great market. A lot of people fall asleep on it. It's over 1 million MSA, and it's nice steady growth. Phoenix has skyrocketed in pricing and rent growth, and it's certainly come down quite a bit. Where Tucson is just nice and steady, which I like. So these are some of the highlights of why we like this deal. We'll renovate 40% of the classic units that haven't been renovated. There's also a significant opportunity to reduce operating costs. They don't have any low flow toilets on the property. I'm going to shoot ahead. So the toilets on the property, whoop, when you flush it, it's 3.5 gallons per flush. When we put in our low flow toilets, it's zero point 0.8 gallons per flush. So massive savings. And then we'll put aerators on the shower heads and the faucets. So we'll be able to install this within 6 days. In about a month or so, we'll have a team come out and go through all the units. And our immediate savings over the course of a year is $138,000, which is huge. And if you divide it by the cap rate, that becomes an overall property value increase by $2.8 million. And that's not including all the other things we're going to do to start off with a $2.8 million property value increase is huge.
Hey, Gary, it looks like a second question's come in.
Right.
I'll read to you.
So the question, go ahead.
I'll read to you. Yeah, I've sold my business. What happens to my tax obligation if I reinvest part of that money with your syndication?
Yeah, most likely you can do that. Again, every tax CPA is a little bit different, but I've known people that have done that, and it's a great tool. I've actually done it myself too. When I sold a business before getting into real estate full time, and I used some of those gains to get I used some of that bonus depreciation to offset some of my gains. So another operational expense we're going to reduce is insurance costs. They had an insurance claim and the prior ownership, and that'll reduce our insurance bill about 52% because that'll come off once we take over. And we'll also add income lines like pet rent. Um, you'll see it's kind of hard to see, but the on the lower levels units they have patios but no privacy wall. So we're going to add privacy walls and be able to get an additional $50 per unit uh, per month. So that's huge. It's a huge opportunity for us. The opportunity we got about 20% reduction in price when we put it on the contract, and then we also got a $1.5 million discount recently. So we're buying this property for under $129,000 a door, which is huge. We've seen properties that are Class C, C minus, go for quite a bit more recently. So really excited about the basis that we're getting this property at. And also, the previous owner put in about $3 million over the last few years in CapEx. So improving the properties. And we have about a $2.4 million budget for CapEx as well. Half for interiors, landscaping, do some design work, add some pergolas. So if you don't know Tucson, I want to just briefly show you the pretty diverse job market that is there. Which is good because if you have one huge employer, and they move, they go out of business, that has a huge effect. But Tucson is pretty diverse. So on our current opportunity, we have three classes. There's Class A, that's preferred equity. So there is no upside, there is no bonus depreciation, but some people just want that consistent cash flow that we pay out. It's 10% per annum paid monthly. Um, most of our investors go for Class B. You know, those are the types of investors that invest anywhere from 100,000 to 500,000. Um, they get a 7% pref, 100% of their money back first. Then we do a 70-30 split to 15% IR. So 70% to investors and 30% to the management, our management team. And then after 15% IRR, it's a 50-50 split. Distribution is quarterly, but we typically it'll come about 6 months into the deal because we're doing the value added. It's coming from cash flow. We don't raise extra money to pay back our investors. Then we have Class C institutional. So that's for people that are investing $1 million or more. They get an 8% pref, 100% of their money back, and then an 80-20 split. There's no additional waterfall. So a couple of different ways to invest. And do know that I'm one of the biggest investors um, in the property. Most of the team invests as well. So we definitely have a lot of skin in the game. And I'll bet on myself all day long. So I wanted to share a slide for projected returns. So as you can see, so the first year we're projecting about a 2% dividend. So that if you invest 100,000, that comes about $2,000. Year two, it goes up to 3,000. Year three, 4,000. Year four, 5,000. We underwrote it to 5 years, but we really feel like we're going to sell this deal within 3 years. We typically like to double your money in about 3 to 5 years. On the deals that we've exited, um, we've done that in about 2 years, but I'd rather underpromise and overdeliver. Certainly, times are a little different. We're not having the massive rent growth that we've had the last few years. So it's slow and steady. It's slow and steady growth. We implement our business plan, and by renovating the property, improving operations, and then we'll start generating cash flow. Um, and it's just a great way um, to invest with a fixed asset. You're not investing in a paper asset. This is truly a hard asset. So one thing that's important to our whole team is um, win-win scenarios for our residents, for the community, for our investors. So we do donate a significant amount to some of these charities that I've listed here. And here's some testimonials. We were recognized by Inc. magazine as the 25th fastest growing real estate company in the United States. Um, Certainly, we're going to go backwards this year. This is our first deal in 14 months. We underwrote a lot of deals, put offers in, but what we were willing to pay and what the seller was looking for was there was definitely a big gap, and we stayed true to our criteria. We weren't doing deals just to do deals just for fees. That's not how we operate. So we were very selective, and we're very excited about this deal that we're finally closing, hopefully tomorrow. But we were recognized also in Yahoo Finance, LA Weekly, shout out Arizona, um, AAOA, which has I think over 143,000 members now, recognized us as the best syndicator last year. We did 4 deals, totaling $132 million. Um, and this year, yeah, like I said, we'll close the year with just a $33 million purchase. So here's a link to our website. We have a lot of educational videos. There's links to YouTube. We have investor tools that people have said have been super, super helpful. You can access the deal. But happy to take any other questions about the deal, about bonus depreciation. Um, you know, don't be shy. Maybe a question that you have, someone else is thinking. So don't hesitate. All right.
So one question just came in.
All right.
What is projected AAR and IRR? Come cash on cash, minimum investment.
Yep. So the AAR, I believe, is about 20 to 22%, I believe. Correct me if I'm wrong, Adam.
That's what we
Um,
have, yes.
all right. And the IRR is 16.6%. Cash on cash. Um, Usually people do the pref number, the 7%. But I mean, you saw the cash on cash. the real cash on cash is going to be lower. I would say closer on average to about 4%. Um, do know on the pref, it's not compounded, but it's cumulative. So if we don't pay, we're not going to pay out the 7% the first year. Realistically, we're not going to have that as much cash flow, but that's cumulative. So you'll when we sell the property, that'll be a catch up. Our minimum investment is typically 100,000, but some people have asked to come in for a little bit less than that, and we'll accommodate you. Just reach out to Jacqueline or Adam on our team, and we'll work with you. I'd rather have people come in and see the great work that we're doing and building trust, and then you can always invest more later. We've had uh, the bulk of our investors keep coming back and doubling down on their investment.
Let me see if this is the same question or a different one. I think that was the same one. Okay.
Any other questions? Well, I mean, we have a little bit of time, and I want to talk about what we foresee um, coming in 2024, 2025. Um, there's a tremendous amount of opportunity, and we feel now is the time to buy because we rates are high, and so pricing is significantly discounted. But as rates start coming down, cap rates become compressed, and now people are going to be jumping into the market because there's trillions of dry powder sitting on the sidelines, and so pricing is going to go up, and you're not going to get as good deals as you're getting right now. And so when people are kind of waiting for that bottom of the market, we're really sitting in it right now. Um, as you can see, the stock market has really jumped up in the last few weeks. The Fed is signaling that they're going to be cutting rates significantly in 2024 and 2025. So now is a great opportunity to buy and invest your money to put it to work. Um, I'm putting my money to work. Like I said, the bulk of our team is investing in this deal. For those of you that want more diversification, we do have a fund so Spanish Trail is part of the fund that we're launching. So you can invest in just Spanish Trail or the fund. And the fund, this is the first deal in the fund. We're gonna be putting 3 to 5 deals into that fund, and it's a closed-end fund. We'll look to close it probably around summertime. Any other questions? Well, I appreciate you coming on. I know everyone's got a busy schedule. And hopefully you took away a couple of aha moments. And we hope to, if you haven't invested with us, we hope that you invest with us soon. Remember, if you want that bonus appreciation, it does close out December 31st for this year. So take advantage of it now. Put your money to work. Um, and we'll see you soon. Thanks so much.